For many foreign investors in Vietnam, the early stages of business are focused heavily on survival and growth. Company setup, licensing, hiring, sales, operations, and building market presence. But once the business finally becomes profitable, another important question appears: how do we legally transfer profits abroad? Many foreign investors assume this process is straightforward. The company earns profits, taxes are paid, and funds are transferred overseas. But in Vietnam, profit repatriation is closely tied to accounting compliance, audit readiness, tax documentation, and financial transparency, and this is where many foreign-owned companies encounter unexpected delays. Because accounting mistakes that seem small during daily operations can suddenly become major obstacles when the company tries to remit profits abroad. One of the biggest misconceptions foreign investors have is believing profit remittance is mainly a banking procedure. In reality, Vietnamese banks, auditors, and regulators often require substantial documentation before overseas profit transfers can proceed smoothly. The company may need audited financial statements, completed tax obligations, proper accounting records, supporting documentation for transactions, and consistency between financial reports, banking records, and investment registration documents. This means the quality of the company's accounting structure directly affects its ability to transfer profits abroad. If accounting weaknesses exist, profit remittance may become delayed or complicated. One of the most common reasons profit repatriation becomes difficult in Vietnam is weak supporting documentation. For example, companies may record expenses without sufficient invoices, intercompany payments may lack proper contracts. Payroll records may not fully align with labor declarations, or certain transactions may not be adequately supported by banking documentation. During normal operations, these issues may appear manageable, but once audited financial statements are required for profit remittance purposes, auditors begin reviewing whether the accounting records are reliable and defensible. And if supporting documentation is incomplete, auditors may raise concerns that delay the overall process. Another major issue foreign investors face in Vietnam involves unresolved tax compliance problems. Some companies assume that because monthly filings were submitted, all tax obligations are fully compliant, but during audit preparation or banking review, inconsistencies may appear. Incorrect tax treatment, unpaid obligations, unclear expense classifications, or unsupported deductions. In some situations, the company may need to clarify historical accounting treatment or resolve outstanding tax issues before profit remittance can proceed. As a result, foreign investors often realize too late that weak accounting practices can directly affect access to profits already generated by the business. Many foreign-owned companies in Vietnam regularly conduct transactions with overseas parent companies or affiliates. Management fees, service agreements, loans, software licensing, or operational reimbursements. However, these transactions often receive higher scrutiny during audits and banking review processes connected to profit remittance. If the agreements are incomplete, pricing lacks commercial justification, or documentation is insufficient, auditors and banks may request additional clarification. This can significantly delay the transfer process. For FDI companies, intercompany transaction management is one of the most underestimated accounting risks connected to overseas profit transfers in Vietnam. Many startups and SME foreign investors entering Vietnam understandably try to reduce operating costs during the early stages, and accounting providers are frequently selected based mainly on low monthly fees. At first, everything appears functional, reports are submitted, taxes are filed, operations continue normally. But years later, when the company attempts to repatriate profits, hidden weaknesses begin appearing inside the accounting structure. missing documentation, inconsistent records, weak audit preparation, or accounting treatment that cannot withstand professional review. In many cases, the accounting system was built only to satisfy filing obligations, not to support long-term financial defensibility, and profit remittance is often the moment these weaknesses finally become visible. Imagine a foreign-owned consulting company operating successfully in Vietnam for several years. The business grows steadily, revenue increases, and management decides to distribute profits to overseas shareholders. But during the process, auditors identify multiple concerns. Several expense records are insufficiently supported. Intercompany reimbursements are poorly documented, and payroll declarations contain inconsistencies. The bank then requests additional clarification and supporting records before processing the overseas transfer. Management suddenly realizes the company's accounting structure was never designed for long-term compliance defensibility. The profit remittance process becomes delayed, while historical accounting issues are reconstructed and clarified. This situation is far more common among FDI companies in Vietnam than many foreign investors expect. For foreign investors in Vietnam, accounting is not only about submitting reports or avoiding penalties. Strong accounting structures help companies complete audits more efficiently, reduce tax exposure, maintain stronger banking credibility, support smoother investor reporting, and facilitate overseas profit transfers with fewer complications. In contrast, weak accounting structures often create operational friction that becomes visible only during critical business moments, and profit repatriation is one of the most important moments for any foreign investor. At LTS Law, we regularly advise foreign investors who encounter operational difficulties connected to accounting, audit, and compliance issues affecting profit remittance in Vietnam. Although LTS Law does not directly provide accounting or audit services, we help foreign investors identify professionally assessed accounting and audit partners experienced in supporting FDI companies with stronger transparency, English communication capability, responsiveness, and practical understanding of foreign invested business operations. Because sustainable business operations require more than generating profits, they require compliance systems capable of protecting those profits when the investor needs access to them. Many foreign investors focus heavily on entering the Vietnam market, but fewer investors think strategically about what happens after the company becomes profitable. At LTS Law, we help foreign investors understand that profit repatriation depends heavily on the strength of the company's compliance structure long before any overseas transfer occurs. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on accounting oversight, audit readiness, or selecting suitable accounting and audit partners, book a consultation with LTS Law, because in Vietnam, accounting mistakes made today may delay access to your profits tomorrow.